Hello everyone. In this particular recording, we're going to go through our homework for chapter 13. And so in this chapter, we were talking about capital budgeting decisions. And as you recall, we were looking at utilizing a lot of this information by converting future dollars, whether it's a future cash inflow or a cash outflow, back to present value. My point is this. In this particular chapter, you're going to need the tables to convert a present value of $1 as well as present value of an annuity. Those tables are towards the end of chapter 13 in your textbook. I highly suggest that you copy them, you photocopy them, make sure you have them with you. You will need them in order to help with the homework as well as the exam. Okay, so let's take a look at this first homework example. We have a company called Unter Corporation. They are considering an investment with the following cash flows. And you can see in year one, they would have to make an upfront investment, which is a cash outflow of $15,000. And in year one, they're only going to get $1,000 back as a cash inflow. In year two, they are to make another cash outflow of $8,000. But they are to expect $2,000 back as a cash inflow. So as you can see here, we have very uneven cash inflows and outflows. And because they are uneven, if we are to determine the payback period, we need to prepare a table that looks something like this. And you can see it here. It's really three columns. Year one, we have our investment, which once again, this is our cash outflow of $15,000, less our cash inflow. And that gives you your third column, which is called the unrecouped or unrecovered investment. Think about it. If $15,000 was the cash outflow, less a cash inflow of $1,000, there's still $14,000 that we need to recover. Now in the next year, we're going to say $14,000 plus another $8,000 cash flow. Now the 14 plus 8, we have $22,000 that we still have to recover. And if we have a $2,000 cash inflow, 22 minus 2 will give us 20. In year three, no more cash outflow. Now it's all cash inflow. 20,000 minus 2,500, we now have 17,500 unrecouped. The next year, 4,000. We're recouping. Now our unrecovered investment is $13,500. You clearly see it takes somewhere in the middle of year 7 to recoup everything. So 6+ years. And since year 7, we're expecting a cash inflow of $5,000 and we have $2,500 unrecovered. We're expecting somewhere in the middle of year 7, we should recoup everything. With that said, we're going to say that the payback period is approximately 6.5 years. And number 2, will the payback period be affected if the cash inflow in the last year were several times as large? So we're saying in year 10, instead of it being a $2,000 inflow, let's say it's a $200,000 cash inflow, for all I care. Does that affect the calculation? And the answer is absolutely not. So it's not affected by the last year. It's only affected, obviously, in the time period that we're trying to recoup our investment. So this is a very quick analysis. This ignores the time value of money, this concept of payback period. It simply tells us how long to recover our initial dollars. And in a high interest rate environment, this would be a critical mistake. Obviously, with the time value of money being much different when we have a higher interest rate environment. Okay, and with that said, let's jump into our next homework problem where we will consider the time value of money. So let's read. The management of Kunkel Company is considering the purchase of a $27,000 machine that would reduce operating costs by $7,000 per year. At the end of the machine's 5-year useful life, it will have 0 scrap value. The company's required rate of return is 12%. Okay, so what we need to do is determine the net present value of this investment. Once again, if we purchase this, it's going to be $27,000 up front, and for 5 years, we should be able to reduce operating costs by $7,000. Now, ignoring the time value of money, you say to yourself this: I will be able to save $7,000 a year for 5 years, or $35,000. And by saving $35,000, I need to spend $27,000 now. So ignoring the time value of money, you say, heck yeah, I'll spend the $27,000 so I can save $35,000. But that would be the wrong analysis. The reason why it's the wrong analysis is because those cost savings are in the future. And when there is a cost to capital, all right, as is the case all the time, all right, the dollars that we spend or save in the future are actually worth less than today. All right, today's purchasing power of a dollar is going to always be higher than in the future. So what we need to do is we need to bring everything back down to what we call present value. In order to do so, we would need our present value of $1 table. And once again, this is in the back of chapter 13 in your text. So we're going to prepare a table that looks like this. Okay, right now, this is what we're spending right now, $27,000. Okay, so we're going to see that in brackets. It's a cash outflow, negative $27,000. And for the next 5 years, we're going to be able to save $7,000 in operating costs. Those would be the cash inflows over 5 years. But what we need to do is we need to consider that our required rate of return, all right, this is basically our cost of capital, if you will. Whenever you hear someone say required rate of return, this is our cost to borrow money, let's say. This is 12%. This is the going market rate. If I went out and borrowed money today, this is what I would get, 12% rate. And so using your present value of a $1 table, you will look at that table and there will be a column where you see 12%. Up the top of the columns are percentages. So you go to the column that says 12% and you go across the left-hand side of the table, you're going to see time periods. You'll see period 1, period 2, period 3, period 4. So if you go to column of 12% and you go to period 1, you will find this factor, 0.893. You will take that factor, multiply it by the cash inflow, and you will get a present value number. Year 2, 7,000. But if you go to the 12% column and the second period row, you're going to find this factor, 0.797. What are we doing? We're basically converting the $7,000 in physical cash that we would receive, or in this case, save in the next 5 years, and converting it to present value. When we do so, if you add up the 5 numbers that I have highlighted here and subtract out the 27,000, it is a negative net present value. With negative net present value, effectively you would reject the project. Okay? We would not want to accept anything that has a negative net present value. All right, so this, if we were going by net present value, we would reject it. Okay, next homework question. We have a donut shop. Wendell's Donut Shop is investigating the purchase of a new $18,600 donut making machine. The new machine would permit the company to reduce the amount of part-time help needed at a cost savings of $3,800 per year. So some poor part-time minimum wage employee is going to lose their salary of $3,800 a year if we buy this new machine. In addition, the new machine would allow the company to produce one new style of donut, resulting in the sale of 1,000 dozen more donuts each year. The company realizes a contribution margin of $1.20 per dozen donuts sold. the new machine would have a 6-year useful life. So, what would be the new cash inflows if we bought this new machine? Well, savings on the part-time help, even though that's not an actual cash inflow, it's just as good, right? It's cost savings. So effectively, it's the same thing. The $3,800 plus $1,200 in additional contribution margin on new sales of the new donut, which is 1,000 times $1.20. That's where you get your $1,200. So altogether, my cash inflows on an annual basis will be $5,000 if we accept the purchase of this new machine. Now, the second requirement here is to find the internal rate of return. Now, the internal rate of return, this concept, is when the net present value equals 0. This is what this means. When the net present value equals 0. What would it be promised? All right, well, the investment, as we said, was we have it up here, was $18,600. That is your numerator, and your denominator is the cash inflow, which we just calculated at 5,000. What we get is a factor, 3.72. And what we're going to do is we're going to look at our present value of an annuity table, and when we go across, all right, when we go across and we figured out this is a, what is this? This is a 6-year useful life. All right, so if I go across row 6 and I keep going until I find this factor of 3.72, it falls closest to the column where the rate of return is 16%. That is how you calculate the internal rate of return. Okay, once again, the internal rate of return is when the net present value is 0. And the last question here, in addition to the data given previously, assume the machine will also have a $9,125 salvage value at the end of year 6. Now, with that new factor, we have thrown in this one last factor, this $9,125 salvage value. What is the new internal rate of return? Well, instead of it being 16%, we've calculated it's now 22%. How do I do that? Well, once again, you got to put a table together that looks like this. Right now, spend the $18,600, since that's already at present value. There it is, negative $18,600, and then $5,000 a year for 5 years. And then in year 6, not only the $5,000 savings, but in addition, the $91.25 in the salvage value of the machine. So total cash flows in year 6 is $14,125. And what we need to do, since the cash inflows are no longer even every single year, what we need to do is we need to go ahead and figure out using a trial and error method to try to make sure we get this net present value to 0. And by playing around a little bit, and when we use a discount, all right, once again, the discount is pretty much your minimum required rate of return. When we play around with it and we looked at the 22% column and we use these factors for year 1, 2, 3, 4, 5, and 6, that is when we can get to a net present value of 0. All right. Now, obviously, this is a and we have it written here. We have it written there. It is a trial and error situation. So you can see the internal rate of return goes up 22%. And once again, if the net present value is 0 or positive, you accept it. If the project is negative net present value, you would reject it. Okay, next. Next we have a company, Luco Products. They're investigating the purchase of a piece of an automated equipment that will save $400,000 each year in direct labor and inventory carrying costs. So we're trying to actually, use some technology that is going to save us on some manual labor, as well as some carrying costs in our warehouse. We don't have to carry so much inventory. Now, yeah, it'll save $400,000 a year, but the equipment is pretty darn expensive. The equipment is going to cost us $2.5 million. If we buy it, it's expected to have a 15-year useful life, but when we're done with it, it's going to be junk. There will be no salvage value. The company's required rate of return, remember, that's the discount rate or the cost of capital. How much would it cost us to borrow money? It's 20% on all equipment purchases. Management anticipates that this equipment will provide intangible benefits, such as greater flexibility and higher quality output that will result in additional future cash inflows. Well, intangible benefits is always a good thing. It's nice to know that we have flexibility, we've got higher quality output. This is all fine and dandy. The problem is this: it is very difficult to put a dollar amount on intangible benefits. So when we have a situation like this, we can try to figure out, well, at least what dollar value could we put on these intangible benefits? And what you're going to do is you are going to prepare a schedule that looks something like this. Your numerator is going to be the required increase in present value, $600,000. How do I know that? Well, if we take a look at our net present value calculation, right now we need to spend $2.5 million. That's already at present value. That's why in the present value column we have negative $2.5 million. But we said every year for 15 years we'll be able to save $400,000 on operating costs. Well, if you go to your present value of an annuity table, all right, this is an annuity because it's the same amount of cash inflow every year for a number of years. So that's why you use the present value of an annuity table. And you're going to go to period 15, since we're dealing with 15 periods. And we said that our required rate of return, our discount rate, is 20%. So you go to the 20% column, the 15 row, you're going to find this factor, 4.675. Multiply it by 400,000, you get 1,870,000. You can see the cash outflow of 2.5 million less your annual cost savings adjusted to present value of 1,870,000. The difference, negative $630,000. So that's why we say the intangible benefits need to be worth at least $630,000. That is your numerator. Your denominator is the factor that we used, and here's the factor, the 4.675. So taking the 630,000, factoring it over 15 years, 4.675, the annual value of the intangible benefits is $134,759. So if in your determination, if you believe those intangible benefits of greater flexibility and a greater work product and all of those intangibles, which are very difficult to place a dollar amount, if you believe they're worth at least $134,759, it's a go. But that's something that you need to analyze. Okay, next. We have 4 investment proposals. And you can see we've done our calculation for our cash outflow, which is the original investment. And then we compare that to the present value of all the future cash inflows. And the result, as we've concluded in the past, is net present value. All right, looking at the net present values, which one's the highest? Well, it looks like this one, D. So everything else being equal, that's the proposal that you would accept first, proposal D. But it doesn't always work that way. We can see each investment has a different lifespan. Investment A has a 5-year life, B 7, C 6, as well as D 6. And so what we need to do is, instead of ranking the investment proposal, based on net present value, we're going to base it off of what's known as project profitability. So how do we calculate project profitabilities? Well, what we're going to do is we're going to take the net present value of the proposal and divide it by what's the investment required up front. When we do that, what is the best ranking? Well, that's going to be C. This is the best bang for our buck. Now, the one that has the highest net present value, this is pretty interesting, of $40,000, using project profitability, D is actually the worst out of the 4 proposals to take. So my suggestion is not only calculate the net present value, and once you have a positive net present value, if you still are trying to choose between alternatives, you should take it one step further and actually figure out what's known as the project profitability by simply taking the net present value divided by the investment required. The higher the profitability index, the better the product is going to be. So the ranking is going to be C first, A second, B third, and D last. Okay, another homework question. We have a company. They are considering the purchase of an automated bottling machine for $120,000. The machine would replace an old piece of equipment that costs $30,000 a year to operate. The new machine would cost $12,000 a year to operate. So you see that? We're actually saving $18,000 a year if we replace the old machine with the new machine. The old machine currently in use is fully depreciated and could be sold now for a scrap value of $40,000. The new machine would have a useful life of 10 years with no salvage value. So we need to compute what's known as the simple rate of return. The simple rate of return is a formula. The numerator is going to be the incremental net operating income, the additional net operating income, if you will. And that's accounting income. So we're not talking about just cash. We're talking about accounting income. Divided by your denominator is going to be the investments, the initial investments. So let's figure out the incremental net operating income. Now, the old machine cost us $30,000 a year to operate. The new machine is going to cost us $12,000 a year to operate. That's an additional $18,000. All right, but there's one more thing. Remember, if we buy this machine for $120,000 and it's got a 10-year useful life with no salvage value, you have to also consider when we're calculating accounting income, even though this is a $12,000 non-cash expense, depreciation we're talking about, we still have to consider it. So the actual increase in the net income is not the full 18, but it's going to be $6,000. Now the new machine, $120,000. However, I'm going to be able to sell the old machine right now for $40,000 for an initial investment of a net $80,000. If you take your $6,000 divided by your $8,000, that's where you get your simple rate of return, 7.5%. Once again, it ignores the time value of money, but this is one of those quick analyses that some companies are going to do to eliminate some of the investments right off the top without getting too detailed. And the last homework problem, we're actually going to take a look at a whole bunch of different analyses. We have a company, a Sage company, and Lou Barlow, he's a divisional manager. He has an opportunity to manufacture and sell one of 2 new products for a 5-year period. Now here's the problem. His annual pay raise is determined by his division's ROI, which we learned in a prior class. His ROI in the past has exceeded 18% each of the last 3 years. So that's a little background information. Now he's got these 2 potential products to make. Product A and product B. Now product A if I make it, I'm going to have to spend $170,000 up front to buy equipment. If I do, I should be able to generate revenues of $250,000 each year, $120,000 in variable expenses, and $34,000 in depreciation expenses, and another $70,000 in fixed out-of-pocket costs. Product B, it's a little bit more costly, a lot more costly, $380,000, but it will generate more sales revenue, $350,000, and there'll be more variable expenses and depreciation, a little bit less in the out-of-pocket costs. The discount rate for the company, right, the cost of capital, the minimum required rate of return, there's a bunch of names for this, is 16%. So the first thing we want to do is calculate the payback period. Now the payback period, let me show you the calculation. The payback period, first you're going to compute the annual net cash inflows. So with the payback period, we're not talking about accounting income, we're talking about cash inflows. So the two fit as an example, product A, sales revenues of $250,000. I'm assuming we're going to be able to collect all of it. And we have the variable and the fixed expenses. As you can see, depreciation is ignored here. So that's $60,000. If we take our $170,000 investment divided by 60,000 cash inflow, you get 2.83 years. You do the same thing with product B, the sales revenue, less your variable and fixed expenses, you get annual net inflows of $130,000. All right, take that $130,000, well, take the investment required of $380,000, divide it by this net cash inflow, you get 2.92 years. Now they're very close, aren't they? The payback period is 2.83 years for product A, 2.92 years for product B. It's close, but the one with the better payback period is product A, right? You want to get paid back as quickly as possible. Now, once again, the payback period completely ignores the time value of money. So what we really should do is calculate the net present values. And that's what we're going to do in the second part. We're going to look at the net present value for product A and B. Product A, spend $170,000 now, and that's already at present value. And then in year 1 through 5, here's our cash inflow, and we already saw this, $60,000 a year. However, we want to break it down to present value. So what we're going to do is we're going to use the present value of a dollar table, and we're going to go to period 1, which is row 1, and the discount period, the discount rate that we're using. Let me come back up here and refresh my memory. There it is. It's 16%. So if you go to the 16% column and you go to period 1, you're going to find this factor. 16% column, row 2, you'll find this factor, etc., etc. So if you take your physical cash flow, multiply it by the discount factor, you get your present value. Adding up all of your present values, subtracting out your cash outflow, you get a positive $26,440. Product B, you do the same thing. Your net present value is higher. So looking at it purely for net present value, which one is higher? Well, product B would be the winner here. So using payback period, product A. Using net present value, who's the winner? Product B. Next, let's analyze these two investments using internal rate of return. All right, the internal rate of return, once again, you're going to take your investment required divided by your annual cash inflow. You get the internal rate of return. All right, product A, 2.833. Product B, 2.923. And since we're dealing with a 5-year life, what you're going to do is you're going to go to the present value of an annuity table, and you're going to go to row 5, and you're going to go across until you find 2.833. In product A, when you go along that line, 2.833 falls between 22 and 23%. So the internal rate of return would be kind of in the middle, 22.5%. And product B, 2.923, that falls closer to a factor of 21%. So using the internal rate of return, product A is going to have a higher internal rate of return. We would choose product A. Next, 4, project profitability. Project profitability, we take the net present values, which we calculated a couple of steps ago, and divide it by the investment required. Project profitability, you can see product A is preferred over product B. Simple rate of return, this is where you calculate accounting income, and you will consider the non-cash expense of depreciation. And so you take the net cash inflow, subtracted out any non-cash expenses, which happens to be depreciation in this case, and you'll get your annual net operating income. That is your new numerator. Divided by your initial investment, what you get is the simple rate of return. And once again, you will choose product A over product B. So, in conclusion, the net present value suggests B is preferable to A, but pretty much everything else, the project profitability index, you choose A. The payback period, the internal rate of return, simple rate of return, also favor product A. All right, it looks like the overwhelming evidence is product A is preferable. In my opinion, the project profitability index is the best bang for my buck, because you're actually not only considering the net present value, but you're also considering the initial investment, and that really ranks them. It kind of puts everything on the same playing field, if you will, with that calculation.